Most people panic when the stock market crashes, but smart investors get rich. And here's why. They understand the facts about buying the dip. Everyone thinks they understand buy low, sell high, but in reality, when things come crashing down, it looks a lot different. So here are some of the facts. Buying small dips is easy. Buying huge dips is hard. When the stock market dips a couple of points, 3, 4, 5%, it's easy. Investors are happy to gobble up that little discount, especially on their favorite stocks. It's not a real dip, not a real crash at that point. It's more of the volatility and fluctuation of stocks during their normal buying cycles. But when stocks really dip, and I mean 10, 15, 20, 25%, this is when it really becomes hard. When you see your account's net balance start tanking, when things start going into the red, thousands of dollars, that is when it really tests your mental fortitude. Do you have the stamina to stay in your high conviction stocks after seeing them get beaten and battered over the course of weeks and months? Being able to stay in those high value, high growth stocks and even buying into them once they hit those large dips to 10, 15, 20%, that is really what's going to make the difference in your portfolio. One of the biggest mental tortures about buying a huge dip is that you're always subject to your stocks dipping even further. And the reason behind this leads me to my number 2 fact. Nobody, and I mean nobody, can accurately time the bottom of the market. I don't care if you're Jesus, if you're Tony Stark, if you're Light Yagami, I don't care who you are. You will not be able to accurately time the bottom of the market. And because of this, you have to be okay. You have to accept the fact that if you buy into a high conviction stock during a dip, there's a good chance it will still fall some more. And that is why dollar cost averaging is one of the best approach in the stock market, especially on a dip. You can buy as those stocks are coming down and then buy as the stocks are coming up. Sure, you may not put all of your funds at the exact bottom, but at one point you will be buying the exact bottom of this market. Sure, you'll buy a little bit just before the bottom and a little bit after the bottom, but you will ensure that you are putting money into those high quality stocks at that low valuation that they have, a valuation that they may not continue have for very much longer. This isn't a few missed earnings reports or a bad GDP quarter or some business news headlines that are going viral. This is great uncertainty. This is the pandemic. This is the '08 financial crisis. This is something that the markets have not encountered before, and that is what is driving these markets down. People don't know what's happening next. People don't know what businesses will succeed. People don't know the short-term future of their financials. That is what causes people to sell. And when fear gets in the market, fear breeds fear. And with more fear, people start selling, and people start selling more and more. And this is the opposite side of the spectrum, like how it was a few years ago, when people were willing to buy whatever they could, no matter what that stock's real and true intrinsic value was, people were willing to pay above it. And the same thing happens in a crash. People start selling and selling. They're so uncertain. They're so scared. They see their bank account, their numbers, their cash keep on dwindling. And people tend to oversell at this point. And that is when we get our buying opportunities. That is why we buy the dip. That is why we look for value during these great times of uncertainty. And one of the issues that comes with this is people can forget and be misled and get scared out of their own investing tactics. So those big dips can cause investors to give up on their investing strategy, even if they have a winning strategy. Seeing their net worth get cut by 10, 20, 30% can be something that smacks someone in the face and causes them to think, my God, I must be doing something wrong. I need to get out of here. I need to start selling as quick as possible. I need to preserve this little amount of asset that I still have. Even if they were invested in high quality, high growth, high valued stocks, a great time of uncertainty, a huge dip can cause them to lose sight of that winning strategy they had and sell out of those great growth stocks. And I've seen this before. And one of the main transitions that happens is people sell out of these high volatile, more risky, but high potential, high growth stocks into safer assets such as ETFs, dividend ETFs, into money market funds, into bonds. And although this does mitigate risk and it does give them a little bit safer of returns, it gives them much, much smaller returns. And this is when we lose out on the highest return that we could possibly get on the market. When the market dips, when we see Amazon, we see Google, we see Apple, we see Moody's, S&P, we see those great stocks drop by a lot of percent. That's when we want to be buying. That's not when we want to be selling for those super low risk bond yields. We want to be doubling down into our highest conviction stocks, those stocks that we think will be here for 10, 15, 20 years, continuing to provide value to us as consumers. This is the time you want to be buying into them. So even if you had a winning strategy throughout all of this time, as soon as you hit a hiccup, a bump in the road, and your strategy seems to be faltering, you need to ensure that you're looking at your strategy. Is it your strategy or is it the market? If you have a sound strategy, investing in sound fundamental companies that are providing growth, that are providing value, you need not worry. You need to double down and invest in those companies. So if you found some value in this, please like and follow along.